Welcome to the Accountancy Learning AAT sample paper walkthroughs. This video will be about the Level 3 Financial Accounting Sample Paper 2 Task 5. So this is about interpreting financial statements using profitability ratios. Part A asks us to identify two primary users of final accounts. So importantly, we're looking for two. So the primary users are going to be those who are perhaps interested in investing in the business or perhaps giving us money or credit terms. So out of the list that we've got, investors and lenders are the two primary users. We now need to identify the accounting principle being described in each of the following scenarios, and this is the list that we've got to choose from. Sales revenue is recognised when goods and services have been supplied. Costs are incurred when goods and services have been received. So this is about matching time periods with costs and revenue, which is known as the accruals principle. Financial statements are produced using the assumption that an entity will remain in business for the foreseeable future. So there's no immediate concern that the business is going to go under, and that's known as going concern. Transactions and valuation methods are treated the same way from year to year. So if we're treating something in the same way, it means we're being consistent. So that's known as consistency. Assets or income should never be overstated, and liabilities or expenses should never be understated. So this is the principle of prudence. So we are always working on the basis that we never overstate our income because we might not get it, and we never understate our expenses because there could be more there. Part B. The analysis of financial statements using ratios provides useful information when compared with previous performance or industry averages. So we need to identify whether these are true or false. So the first one then is true. So when we are using analysis of financial statements, having a comparison between either previous performance, industry averages, time ranges, etc., is useful information to help with decision making. A business will never use financial ratios to assess its performance. So this is false. The ratios are useful for management, for decision making. So they will be able to use the financial ratios to help assess its performance. Ratios based on historical data can always predict the future performance of a business. So can we always predict performance? Well, we can't. It doesn't matter what we base it on. We cannot always predict the future performance of a business. The statement of profit or loss of a business shows the following figures. So we've got a list of figures there. We need to calculate the return on capital employed, showing answers to 2 decimal places. So the return on capital employed is what have we made against what have we invested. So we're going to be taking the profit or loss for the year, and we're going to divide that by our capital and our non-current liabilities. And then because we're looking for a percentage, we times it by 100, and that gives us the 2 decimal places 59.30%. We now need to calculate the net profit margin. So this is going to be against sales. So we're going to take the profit for the year and we're going to divide it by our sales figure and multiply that by 100, and then that gives us 18.49 to 2 decimal places. Moving on a bit further, the business had a selling expenses to revenue percentage of 13.2 in the previous year. This year it was 15.6. So now we need to complete the statement. The selling expenses to revenue percentage shows, and is it a deterioration or an improvement when compared to the previous year's figure? So it has increased, which means there's more expenses to every pound of revenue. So that means there's a deterioration because we're spending more, but we're not receiving any more. Part D, we need to identify what effect, if any, each of the following scenarios may have on the ratios stated. And we're told that each scenario is independent. So a business has managed to negotiate a lower price with a main supplier of inventory, but it hasn't affected the quality of the goods received. So if we've managed to negotiate a lower price, it means that the profit is going to be higher because it's cost us less, which means if the profit is higher, we're getting more back. So it's going to have an increase on the return on capital employed. And likewise, in the same vein, because it is at a cheaper rate, we're making more profit. So the net profit percentage would also increase. And then the final scenario, the wage rates of administration staff have risen in line with others in the industry. The number of staff employed and their skill levels haven't changed. So gross profit percentage. So now we're talking about wages of staff. Gross profit is only concerned with sales and cost of sales. So there won't be any change to the gross profit, but it will decrease our net profit percentage because the wage rates have gone up. There's no indication anything else has changed. So therefore, it's going to be costing more to employ these staff in line with others in the industry. So it will reduce our profit. And that concludes task 5.